Good afternoon and welcome to the August wrap from CreditSights. We thank you for taking the time to join us today. I'm Pramod Shenoi. I'm the head of research at CreditSights for the APAC region. I also wear the head of financials research cap. And I'm delighted to be joined today by my colleagues, Lakshmanan, responsible for South and Southeast Asia research, introducing Pius Xue, who is joining us to be responsible for East Asia coverage, taking over that responsibility slowly from Zerlina, who will concentrate largely on strategy. And today we also have Stephanie Sim, who works with Zerlina and covering East Asia corporates as well as strategy. So today we've got a lot to go through in terms of content. Just a reminder that in the bottom right-hand side of your screen, you'll see a Q&A box. So please do feed in your questions. It's a live session, so we'd love to hear from you on your questions for today. So I'd like to start with a quick recap on where we stand in terms of strategy in general, and more for a quick recap also of how the month's been. So maybe doing that in the reverse order. It's been quite a fantastic month from a spreads perspective. We're at pretty much all-time tights across different jurisdictions. So today, the index, IG index at about 60, US index maybe about 20 wider, closer to 80. And this is about 20 to 25 tighter than where this year started. So spreads definitely very strong, and we have seen supply this week also very well received by the market. From a CreditSights perspective, though, we do see clouds building up on the horizon. At the last monthly webinar, we had talked about our second half and outlook and into next year. The non-farm payrolls number that came out earlier this month has caused us to bring forward our rate cut assumptions. So we are calling for a cumulative 100 basis points of rate cuts now by the end of this year. And we do anticipate spread widening as we do anticipate that the US economy is going to deteriorate, causing the Fed to cut these rates. Now, we do appreciate that inflation is something that's still a big question mark that's out there, And there is data to say that the last PMI was actually quite strong. But from what we're hearing from our analysts, the consumer is under a huge amount of pressure, and that the added tariff situation is certainly not going to help. We do anticipate, therefore, with the deteriorating economic conditions for spreads to widen. It's quite straightforward to say that spreads would widen from where they currently are, given how tight spreads are at the moment. So we do expect some kind of mean reversion. So the expectation in the US is for USIG to get to about 130. As I said, it's currently at about 80. So that's 130 is the median USIG spread over a number of decades. But if you would look at Asia, we don't anticipate that the 20 basis point tighter spread differential is going to widen, and Asia is going to remain really tight. It's going to widen in sympathy as well. So we do anticipate that Asian spreads will widen. Rates, on the other hand, we do anticipate a tightening of rates. Our call for the 10-year Treasury is at 3.5%. That was originally for 30th of June 2026. We're bringing that forward as well. So we do anticipate that from a total return perspective, investors should be okay. However, from an excess return perspective, given the spread widening expectation, that segment is probably going to be more challenged. So with that, we're going to move into the second half of, or the second most important topic to be discussed today, and that's tariffs and tariff implications. So yesterday was the first day where 50% tariffs came in on India. And I'm just going to turn to Laksh to give us his views on what that means for the Indian corporates under our coverage.
Right. Trump, as many of you would be aware, has imposed a 50% tariff on India. That is a combination of a plain 25% tariff and an additional 25% punitive tariff or duty for India importing crude oil from Russia. Now, this 50% places India at a competitive disadvantage compared to its regional peers. It is actually the highest tariff that US has imposed globally on any country, and it brings it at par with only Brazil in the entire world. What that means for the overall broader economy is that we can expect, or we do expect, some slowdown in growth in India. Our sister company expects close to about 0.5% of a hit for India's GDP growth for this year, and there could be an effect even for the subsequent financial year. We also expect that the investment climate in India will suffer on the back of the tariff, as many of these either foreign direct investments and even the domestic producers will delay their investment decisions in India amidst all these tariff headwinds. We think that in terms of the corporate impact, there are a few companies that will be very much impacted. So one is Biocon. Biocon supplies about or generates close to 40% of its revenue by way of exports to the US, because it has 2 or 3 manufacturing facilities in India and in Malaysia, both of which will be subject to these tariffs. Also, what we need to kind of bear in mind is that Trump has threatened up to a 200% tariff on pharmaceutical imports. So how that kind of plays out is to be seen. Secondly, Tata Motors is also a name that could bear the brunt of tariffs, not because of its production, not because of the tariffs on India per se, but because of the global auto tariffs. The other corporates, such as the port companies like Adani Ports, JSW Infra, even the oil refiners will see modest impact. They won't be severely impacted, but they would be affected because of global supply chain disruptions, because of the tariffs, the reshoring impact, etc. And when it comes to the oil refiners, their inability to, or not inability, but rather the restrictions or the pushback on importing from Russia could mean that they will have to rejig their supply lines. Finally, even the steel producers will be moderately hit as auto component manufacturers who are the consumers of steel, they will export a lot to the US, and because of this 50% tariffs, their business will be hit, and therefore there will be a contagion effect on the steel manufacturers. I'll stop here. I'll maybe pass it on back to Pramod.
And I'm just going to pick up in terms of the financial sector impact. So there are certain sectors, as Laksh pointed out, that are going to get affected. Just from a pure exports perspective, the affected sectors are textiles, auto components, fisheries and shrimp, gems and jewelry. These are quite substantial in terms of the percentages. Now, for the Indian banks that are dollar bond issuers, these are well less than 10% of their overall loan book. They come under broader categories, so it's difficult to get the exact number. But the overall categories sum up to 10%. So we don't anticipate that there's going to be a direct impact or too much of a direct impact. We definitely anticipate that credit costs are going to increase because particularly for more challenged sectors such as textiles and very employment heavy, you would see an impact both in terms of corporate loans as well as any kind of like personal loans associated with that. So whereas like the headline impact might seem a little less, it's undeniable that credit costs are going to increase. And the second factor is whereas again, as a percentage of GDP, the exports might not amount to much. This is something which is definitely sentiment changing and will cause some amount of second order slowdown when it comes to particularly the personal and MSME loans categories for the bank. So overall, we do anticipate that there will be some impact. It's difficult to quantify, but directionally definitely negative. I'm just going to take a moment to move across to Stephanie and check in terms of the Korean corporates because they're very active in terms of their exposure to the US and what it means from a tariff perspective.
Yep. So I'll just quickly break down the impact of the US tariffs, maybe by sectors across the Korean credits that we cover. So for the Korean quasis, we see quite limited impact on the US tariff, given that these Korean quasis, such as Korea Oil, Korea Gas, and KEPCO, they are very domestically focused, and US revenues only account for less than 1% of their total revenue. And in terms of their imports of coal, crude, and natural gas, they also do not have much direct import from Russia, and we haven't heard much criticism from the US on any of these imports. So we think that there is quite limited impact on the Korean quasis that we cover. On the corporates front, for the memory chip makers such as SK Hynix, the company actually has quite a substantial revenue exposure to the US, but we still do not expect the US tariff to have much impact on the top line growth, given that a lot of these chips that are exported to the US are quite price inelastic, and we expect SK Hynix to be able to pass through any of these higher costs to its end customers. For the EV battery makers such as LG Energy Solution and SK On, these companies are able to produce battery demand for the US from the manufacturing plants that are based in the US. So there is not much tariff impact on that front. But with that said, there is still some secondary impact. So for instance, we expect the higher US tariff rates to affect EV demand and ultimately affect EV battery demand for the sector. And there is also some implications of the removal of the consumption tax subsidies because of the changes to the US Inflation Reduction Act that could further weigh on EV demand for the second half of this year. For the other Korean corporates such as POSCO and LG Chem, their direct revenue exposure to the US is actually quite small. But with that said, we see some secondary impact. So for instance, we are concerned that the steel makers and petrochemical manufacturers could redirect some of their US exports back to Asia, and this can result in an oversupply in Asia. And another factor that we are concerned of is we are worried that the steel demand from Korean automakers and electronic manufacturers could be weighed down by the US tariff, and this can result in some secondary impact for these companies. And last but not least, for LG Electronics, the company has about 1/4 of its revenue exposure to the US, but less than 20% of these revenues are actually produced domestically. So we think that this could result in the company losing some competitiveness against manufacturers that have a more US-based production. So as a result of this, we have revised down our top line EBITDA and cash flow forecast for LG Electronics for the next 2 years.
Wonderful. Thanks for walking us through that. So we'll move on from the space of tariffs to the space of initiations. This is the point to introduce Pius. Pius Xue, as I mentioned, has joined us recently, and Pius has already pushed out 2 initiations, one on Rakuten and the other on West China Cement. So I'm going to turn to Pius. And so, Pius, how are these companies and what are your recommendations?
Sure, thanks, Pramod. So just quickly on West China Cement, so what the company does. So West China Cement is a mid-sized Chinese cement producer and operating around 39 million ton per annum capacity in China and overseas. It expanded very quickly into overseas market around 5 years ago across actually 8 African and Central Asian emerging markets across seven countries. So we initiated on the company on August 4th, so around 3 weeks ago, with a technical buy recommendation, and primarily because we think that the upcoming contemplated liability management exercise, aka LME, is going to be successful. And also back then we think that the valuation is also very attractive. It was trading at the 14% yield to maturity for a 1-year bond. So for the 26 bond, fast forward 3 weeks later now, the performance of our recommendation turned out to be quite good. The bond was up 5 points, over 5 points, and the spread tightened over 600 basis points. So after the strong first half results this week, we still maintain a buy recommendation on the bond because we think that there's a high probability of the bond being pulled to par from 98 cents context at the moment, because we think that the LME that's going to happen in around October, November, it's going to be successful. So one way for clients to look at the return is by looking at the total return perspective. So if we look at the current trading context, 98 cents on the dollar, and if it's going to, let's say, pull to par or even pull to call price at the point of the settlement of the LME, that would imply a total return of 5%. Or if you look at it from an annualized return perspective, it's going to be 25%. But that being said, we are, so just looking beyond the liability management exercise, we are cautious about its credit outlook because there are still a few fundamental challenges that the company has, such as frontier market risk, profit repatriation from this frontier market's risk, and also its aggressive expansion and some of the hidden debt on its balance sheet. So we would really recommend clients that have access to our report, our initiation report, to go over the initiation report, or feel free to reach out to us for thoughts around the credit on a longer term basis, especially because as part of the liability management exercise, the company is going to be issuing a new bond. So we would need to be taking a medium to long term view on the piece of a new bond. And just to quickly turning over to Rakuten. We initiated on Rakuten early this week with the underperform recommendation. And also just very quickly on Rakuten. So Rakuten, it's so what the company does. Rakuten is a $13 billion market cap Japanese household name. It's a conglomerate operating across 3 segments: internet services, meaning e-commerce; fintech, meaning banks, credit cards, and securities; And the third segment is mobile. It's Rakuten Mobile, which is the fourth largest and the smallest full-service mobile operator in Japan. And the key thesis of our underperform recommendation is twofold. One is that we think that the bonds have priced in a lot of the positives about the company, such as its fundamental improvement, its non-fintech business improvement in EBITDA and in leverage in the past 18 months or so, and also it's regaining access to Japanese domestic yen market. And also it has the market also pricing a lot of the perceived optionality in disposal of its fintech assets as a way to replenish liquidity and to delever. But however, we think that the bond prices haven't incorporated the fundamental challenges, such as the competition in the two non-fintech segments, i.e. internet services and mobile segment. And secondly, it's a persistent free cash flow, negative free cash flow in the past few years, and even extending to the upcoming fiscal year 25 and 26 also. And also, despite the leveraging that you have seen in the past 2 years also, its leverage is still going to remain high. If you look at it on a high level, for this year, for fiscal year 25, its leverage by our estimation is a non-fintech leverage. It's going to be 15 times still. And extending into 26, it's going to improve, but then it's still going to be 11 times by our estimation. So if you look at all this negative cash flow and high leverage from a big picture perspective, we think that from the bond absolute pricing perspective, where the 27s is trading at 5.1% and the 29 trading at a 6.2%, we think it's quite expensive from absolute value perspective. And if we compare its pricing versus comps such as SoftBank, and compare with the US BB index for the seniors and the US single B index with the perps, we think that the bonds are quite expensive. So that's why we put out with a underperform recommendation. Yep, so much for me.
Thanks for walking us through that, Pius. So tactical buy, which continues on West China Cement, and then underperform recommendation on Rakuten. So two distinct investment considerations there. Moving on to the third phase of our webinar today, we're going to be talking about results and what we've noted from these particular results, some key themes. I'm going to start off with financials and cover mostly the Hong Kong banking sector, Australia, and Japan. So starting off with Hong Kong, we had Bank of East Asia and Dasing reporting. Both of them were up 14% year on year, which was a bit of a surprise to us. For Dasing, it was mostly net interest margins, very good net interest margins, and increase despite the sharp fall in HIBOR. So that was primarily driving their results. Whereas for a Bank of East Asia, it was a combination of lower provisions, which we found surprising given the cycle that we are in right now, as well as a strong boost in non-interest income. We do have a recommendation change. We are changing Bank of East Asia from an underperform recommendation to a market perform recommendation. This is largely on the basis of its capital stack. So the implementation of Basel III has led to a 6 percentage point jump in its CET1 ratio, and its other capital ratios have also jumped as a result. So we do anticipate that they won't really need, from a pure capital perspective, to be refinancing. Liquidity is a different matter. They do have an additional tier 1 that's callable later this year, and there are some tier 2s coming up as well. So for choice, we do think that they should be able to perhaps call those and not necessarily replace those with the capital instruments. So we move from an underperform recommendation to a market perform recommendation, although we are cautious about credit costs that we think are inevitable, particularly as HIBOR has started climbing back up and is back to about 3.3% at the moment. Dasing, we continue with a market perform recommendation. Moving to the Japanese, I think the insurance sector is perhaps a more interesting one. The insurers' underlying results were somewhat mixed. The investment results were where there were challenges because with both higher rates in JGBs as well as the yen strengthening, investment results were quite poor. But the insurance companies have various reserves which they used. Some of them used for smoothing. Some of them did actually book unrealized, move from unrealized losses to realized losses on their JGB portfolio, but then reinvested for better investment returns going forward. What we like about the sector is their stellar capitalization. It's very strong. And I think that the market broadly agrees. We saw Fukoku come to the market. We saw 5.95% as fair value based upon a 20 basis point differential to Nippon Life. It actually priced at 5.75%, where it continues to be. So for choice, we do continue with our outperform recommendations, but this will largely be driven by Nippon Life tightening. So Nippon Life, right now about 143, 145, we see fair value for it as much as 40 basis points tighter at about 105, because we see a 30 basis point differential to AIA, which is at about 75. And we would like to see Fukoku about 20 basis points wider than that. So 105 plus 25 is 125. It's right now trading at about 155. So there is space for this to tighten, but we think that that tightening should be led by Nippon Life. Japanese banks, decent shape, nothing dramatic to report over there. Flat quarter for them on a Q-on-Q basis, but they're certainly feeling more confident about the remaining quarters of the year. And some of them have changed their targets for the year as a whole. So that's good to see. Australians, positive surprise actually. Net interest margins for some of them better than what we'd anticipated. CBA, the market leader, doing quite well. The other three just produce, the other three majors, I should say, just produce short trading statements. We have moved Macquarie to an underperform recommendation because we see the spread differential versus majors is far too tight. So bank as well as group, we have moved to an underperform recommendation. So that's the key run through of the financials. I'm now going to turn across to Stephanie to run through China Tech earnings and what she's seeing over there.
Yeah, so I'll start off with the second quarter, maybe a wrap on the earnings for the companies that have reported. In terms of revenue growth, most of them had beat expectations apart from Baidu and Meituan. So in terms of the various sub-segments, if we are looking at the e-commerce platforms, the sale of electronics and home appliance was still very strong in the second quarter thanks to China's consumption subsidies. For the AI cloud revenues, it was also very strong for Baidu and Tencent, and we are expecting a similar performance for Alibaba, who will be reporting on Friday. In terms of the hardware front, Lenovo and Xiaomi results were also quite resilient, with revenues ahead of expectations. PC shipments were quite strong for Lenovo, thanks to the Windows 11 migration and AI PC penetration. And for Xiaomi, its IoT and lifestyle segment and good EV performance helped to support its top line growth. But I think for the China Tech sector, the key concern was for the on-demand delivery platforms. While JD's revenues expanded and was ahead of expectations, Meituan's delivery revenues decelerated quite sharply, and it missed expectations due to the higher incentive that it offered to kind of protect its market share. On the EBITDA margin front, Baidu and JD and Meituan, they significantly underperformed our expectations. For Baidu's case, it was revamping its search platform, and this kind of affected the monetization rate for the company. And for JD and Meituan, they spent a lot on user incentive and marketing expenses to acquire more users for their food delivery and on-demand delivery services. Meanwhile, for the other China Tech companies such as Tencent, Weibo, Lenovo and Xiaomi, these companies reported either stable or better EBITDA margins, thanks to a better revenue mix and product premiumization. So overall, in terms of the debt matrix, actually these China tech companies, they largely reported an improvement this quarter, either thanks to higher EBITDA or a lower debt, apart from JD, whose gross leverage actually weakened quite materially. So if looking ahead, in terms of the outlook for the second half of this year, we are expecting the top line growth for the China tech companies to largely decelerate. We expect advertising revenues for Baidu and Weibo to still remain quite challenged, but for Tencent to continue to outperform. The higher base of e-commerce, white goods, and electronic sales could also affect the e-commerce platform revenue growth in the second half of this year. For the on-demand delivery services, we are expecting a further deceleration in revenues for Meituan and potentially Alibaba, but for JD to experience still quite good revenue growth. And on the hardware front, we are expecting PC shipments to remain resilient at a low teens percentage, and for Xiaomi smartphone shipments to improve in the second half of this year as it launched new products. Overall, in terms of the EBITDA margin trend, we think it will largely be quite similar to the second quarter, where Baidu, JD, and Meituan, as well as Alibaba potentially, could underperform in the second half of this year, while the other tech companies will likely report stable or better EBITDA margins. So as a result, we are expecting the gross debt matrix of JD, Meituan, and Baidu to further weaken in the second half, but for these companies to still retain their strong net cash balances. So we are not overly concerned on the credit outlook of these companies. But with that said, we are expecting Fitch to revise Meituan's current positive outlook back to stable, given that EBITDA margins will likely significantly underperform the agency's expectations. And we also see some reduced rating headroom for Baidu. And for the other tech companies, we are expecting Xiaomi to receive positive rating actions from all three rating agencies in the next 6 to 12 months. Yeah, that's all for the China Tech.
Thank you. Thanks for running through that so comprehensively. Just taking a step back in our discussions with investors, we do see that with all the movements that on tariffs and US dollar and Fed independence, that investors are thinking very deeply about different options, and they are considering diversification to a greater extent. We have seen a tremendous pickup in terms of interest in Aussie dollar, some amount in euros, definitely the domestic currency, Sing dollar in Singapore, and the CNH market seems to be doing pretty well. So outlooks seem to be coming more from the point of view of let's look at other currency alternatives out there. I'm going to turn to Laksh now. Laksh has done some work on this and looked at South and Southeast Asian corporates, what's really out there, and the opportunities. And he also took the opportunity of writing a note on longer duration bonds. So Laksh, what did you find?
Yeah, so on the currency front, like Pramod was mentioning, we have heard from clients that they are channeling the incremental flows into their portfolio into the non-USD bonds, while not really diluting their current investments in the USD bonds. So this shows that there is a very gradual incremental allocation towards the non-USD bonds, and therefore we took that feedback and tried to do a thematic piece, trying to see if there is relative value opportunities in the non-USD bonds issued by our South and Southeast Asian and Middle Eastern corporates under our coverage. Based on that, we first, in terms of observation, we noticed that PLN's 500 million euro November 31 bond does offer substantial value, This is based, our approach was based on FX swap adjusted basis by swapping the non-USD currency bonds yields to USD currency yield. And based on that, this came as something that offered good value compared to its dollar counterpart. Some of in terms of observation, there are not that many bonds issued in Singapore dollar or euros or Australian currency from among these South and Southeast Asian corporates. So there are not that many options to choose from if investors were to limit themselves to these developed market currencies. However, if they were to kind of be, sideline the fact that the local currency bonds from, say, India, Indonesia, Philippines, they have much less liquidity, then there are slightly more opportunities wherein the swap adjusted yield is comparable or at par with the dollar bond yield. So these mainly come from companies such as Tata Steel, Reliance, Genting Berhad, and Bharat Petroleum. So that's what we have kind of seen and wanted to flag it to clients who are looking outside of USD bond investments. Now, for the second part, we just today published a note where we have looked at the long duration bond. So this is essentially a trade idea piece, and that comes from the fact that the US Fed there is widespread market expectation that the US Fed will imminently cut rates. So that should work in favor of the long duration bonds, and therefore we kind of looked at where we see value in that duration segment. So with that point in view, we kind of zeroed in on a few bond picks. It mainly came from about 6 issuers, both from South and Southeast Asia and also from the Middle East corporates, which we have kind of started looking at since the last 2 or 3 months. So the names are mainly from Saudi Aramco. We prefer the bonds from 2049 to 2064 part of the curve. Then there is Qatar Energy's 2041, Mind ID or Idacel's 2048 bond, then PLN's 2042 to 2050 bond part of the curve. And from Thailand, we like both PTT PCL, the ultimate parent, and PTT EP, the exploration companies, both 2042 bond for each. So our approach is not that much reliant on the US Treasury movement, but rather based on the curve spread differential of the respective issuer, as well as on the relative value basis by comping it with a comparable issuer's long-dated bonds. So that's where we see and we arrived at in terms of that by using that approach. And I think it will be useful for those investors who are looking for opportunities to extend the duration while not trying to take the risk of diluting the credit quality of the components of their portfolio. So I'll stop here and give it back to Pramod.
Thank you very much, Laksh. So just taking a step back, based upon what we had talked about right at the beginning, the outlook, we are definitely far more focused on, we're more comfortable with duration for the right quality of issuers rather than for increasing dramatically credit risk, given how tight spreads are. So the long duration ideas that Laksh has come up with would hopefully give you some good investment opportunities when it comes to duration. When you have very tight markets and you have results that are decent or variable, we do have a lot of recommendation changes. So you may have noticed that actually we've been walking through a fair number of recommendation changes. I've mentioned some of those to start off with. It's rare in this environment to have upgrades. There was one from me, which was Bank of East Asia. We had also Mind ID coming through from Laksh, and I'll hand it over to him, as well as to Stephanie later on SK Hynix, which we moved to an outperform recommendation. But I'm just going to take the opportunity maybe for us to run through recommendation changes that we've recently made. So looking at the financial sector, I already had walked through Bank of East Asia, which moved from underperform to market perform. In Japan, we moved MUFG and SMFG to market perform because we think that the spreads are actually in line with expectation. SMFG are a little bit tight. It's actually trading through MUFG. Mizuho, though, is trading about 10 basis points, 8 to 10 basis points behind them. So we've left it at an outperform. We think that's a little, for choice. Mizuho definitely there's good opportunity over there. Taking advantage of tighter market calls, we had certain outperform recommendations. These are on SMBC Aviation, on Muthoot and Shriram, the Indian NBFCs. We moved them to market perform as well. And these are, there's one more, which is BNI. So BNI, we moved from a market perform recommendation to underperform. So that's on the financial side. Just hand it over to Laksh to run through what's there in South and Southeast Asian corporates.
Yeah, in our space, we moved or upgraded Mind ID from underperform to market perform. This came on the back of our recommendation playing out in comparison to the comms Pertamina and PLN. So Mind ID's bonds had rightly widened on a relative value basis with respect to these two companies. For Indica, we had it at an outperform because during the very sharp bond decline in the early part of the year, the prices had been battered so much that we still saw value. So we clinged on to an outperform recommendation, even though the fundamental outlook was poor. So in the early part of this month, we downgraded it from outperform to market perform. And subsequently, we actually had a call with the company through which we came to know a lot more. And on the back of that, we again downgraded it from market perform to underperform because of a very expectation for a deteriorating fundamental outlook. We also downgraded Genting Berhad from outperform to market perform. Similar case where our call for spread tightening rightly played out. In fact, it tightened by as much as 50 bp from 150 to 100 bp over a short course of just 1 month. Another call that played out right was Aramco, which we had initiated in end June, and with an outperform recommendation, the bonds tightened by, I think, about 30 to 40 bps, which is quite rare for a high quality AA kind of a credit. So we took profit on that and we moved it from an outperform to market perform recommendation. So these were the main recommendation changes that we did, and I'll pass it on to Stephanie.
So this week we upgraded SK Hynix to outperform from market perform. This comes after a positive rating action by all 3 rating agencies over the last 1 month. So for SK Hynix, we actually downgraded it to market perform earlier this year as the dollar bonds were trading slightly tighter than Asia BBB and BBB plus corporates, but it was a BBB flat credit. But with that said, we are still very constructive on the credits outlook for the next 6 to 12 months. And we think that it is going to be very likely that SK Hynix will eventually be upgraded to BBB plus over the next 6 to 12 months. And we're expecting the company to potentially turn into a net cash position. Currently, in terms of the RV relative value front, is dollar bonds are still slightly wider than Asia BBB plus corporate. So we think that the markets have not fully priced in the positive rating actions of the company. So we see some room for spreads to further tighten, and we prefer its 2033 bond in particular. Maybe in terms of reg change, I have one more to highlight is that we downgraded by to underperform from market perform following its weak second quarter results. Baidu trades very tight within the Asia A-rated corporate space. It's only 4 to 8 bits wider than Alibaba and Tencent, even though these two companies have a higher rating, and the spread difference are much tighter when we compare it to the average levels of Asia A plus and A minus corporates. And for Baidu's case, its credit outlook is also quite weak for the next 6 months, and hence this was the reason why we underperformed the credit.
Great, thanks for that. I just want to flag off a couple of things. One is some other notes that we put together, as well as some of our general taking a backward and slightly forward look in terms of initiations and other areas. So two notes I'd like to highlight for our viewers. We put out a post-issuance note on Samman Capital, the Indian NBFC. That's a very thorough analysis of what we can see in the issuer, as well as where we see relative value. And the second was a short note on Macau banks. We do have a couple of issuers from Macau, and it's not really a sector that's covered really well. So it's the one-off piece, just to take a quick dive into the issuers from Macau and our findings. So for subscribers, please look out for those one-off standalone pieces. The second element is more in terms of what we've been doing on coverage. From the beginning of the year, you would have seen that we've increased our we've begun to initiate our names in the Middle East. We have Pius with us, and he's come out with Rakuten and West China Cement. There's more to come from there. On the financial side as well, we have gone into Mongolia with where sovereigns is one sector where we work together with our sovereign analyst and came out with a Mongolia sovereign initiation. We came out with Gollum Bank as an initiation, and a number of other initiations that we're working away with. We do appreciate that there's a lot of new issuance in the market, and there are lots of new names. The Japanese, for example, are coming in good force, particularly for longer duration bonds, since in Japan, with yields rising, the amount of demand for longer duration bonds has dropped. So we're seeing some issuance over there. So we do appreciate that there's new names coming, every now and then. So we'll try our best to write new issue notes on these names, as and when they come to market. I think we've been quite nimble in terms of our new issue notes so far, and we do intend to continue to do the same. We've had quite a few questions coming in. We've fed in the answers as we've talked about things. There are a few sector-specific questions that we'll individually respond to the different different investors. So with that, I'd just like to thank you very much for your time today in joining us. We do hope that you found this webinar useful, and we look forward to catching you at our end of month webinar next month. So thank you very much for joining, and have a good rest of your day.